People have lost the plot. People have forgotten how to properly think. Sometimes I get those comments, right? You told me to buy ABC and it went up. Thank you so much. I made some money. Or other people say, you told me to sell ABC and then it went up. Why did you tell me that? Right? You should have known that the asset goes up. And yes, there's always a disclaimer that people give, right? There's a disclaimer. I don't know where the market is going. Do your own research, etc. But the entire thinking around this is wrong. What I've just described is deterministic thinking. It's thinking based on the outcome. So we look at a decision, we look at the outcome, and based on whether or not the outcome was favorable or not, we then decide whether or not the decision that we initially made was good or bad. But that's a very bad way of judging a prior decision. Just think about this in other contexts. Let's say you want to go to an event and your friend says, don't drive yourself, it's too packed over there, just take the taxi, for example. And so you take the taxi to the event and then the taxi suddenly crashes. It crashes on the way to the event. Maybe you did not get hurt, everything is fine, but at least you got, let's say, delayed. You didn't come on time. You could then say that the decision to take the taxi was a bad decision because the taxi crashed. But the decision wasn't necessarily bad, right? Maybe if you would have driven yourself, you would not have crashed, but you also wouldn't have been able to find parking. Really, it was impossible for anybody to anticipate that the taxi is going to crash. So with the knowledge that we had at the time, it was the right decision. We were simply just unlucky. There was a factor outside of our control that we couldn't adjust for. Or maybe let's say you booked a flight and the flight gets delayed, the flight gets cancelled. Again, if you then reason that it was a bad decision to book that flight, you're very bad at improving your decision making over time. And that's ultimately what we want to achieve. We want to make better decisions. We want to distill what is luck, what is outside of our control, what can we not anticipate, and what is expected value? What is probabilities? Because ideally, we want to make decisions based on that. Not on the outcome, but based on the probability. And so most things in life are a combination of both luck and probability. And luck I simply just determine as a thing that we cannot control, that's impossible to anticipate. Now, very often, this luck or bad luck component doesn't necessarily shine through because those events don't happen that often, right? For example, this taxi crash. But in fields where competition rises quite a bit, the luck component becomes more important, as in the luck component is a bigger determining factor of the outcome. We still have a skill component, we still have probabilities, but the probability component comparatively won't be as much of a deciding factor compared to the luck component, simply because there's already been that much competition, so much refinement in strategies, etc. Trading is no different. In trading, we've got both the luck component and the skill component. And so let's go with the example, right? I like this particular investment a lot. I made a lot of research on it. I do think that this investment is going up. It's going up maybe because it has positive momentum. It's going up because it's very trendy. Or it's going to go up because it's very cheap. Or maybe simply because I expect more buyers in the future because I've done my research. Maybe let's say an influencer buys a particular asset and then recommends this to the following. And then the following is going to buy. I don't necessarily think that the asset is great, but I think that all the followers are going to buy. And that's why I am buying, because I found out about the ownership, that particular asset, by the influencer earlier than most others. So there's all kinds of reasons why we might want to buy something. But here's the thing. There is always a luck component. So we should never, ever get all in on any investment. So even in that example, right, where we know about the purchases of that particular influencer, maybe this time around, he won't recommend the asset to the following. Or maybe the following isn't interested in that particular asset. Or maybe that particular asset or the company or the project, it gets into deep trouble between the time when the influencer is buying it and the time when the influencer is recommending it. So we are buying it together with the influencer and suddenly the project crashes before the recommendation. So there's always a luck component involved, even if we expect that the price is going up. That's why we should never go all in. There is never 100% certainty. And so this then scratches the topic of risk management, right? When you think that there's a high probability of a certain outcome, of course, it's okay to purchase more of something, but it's important to be able to recover from a potential loss in the worst case. So let's say you invest half of your entire net worth in something, and that something goes to zero for whatever reason. Now, from that lower base, you have to double your portfolio again just to be back to zero. So the stronger the drawdown is, the more you have to recover, right? Let's say you put 80% of your portfolio in one single thing. Then you're going down 80%, you've got 20% left. Now you need to do another 5x from that lower base just to be back to zero. And so, of course, the more risk we take, the harder we fall, the harder it is to recover again. We want to reduce the risk of ruin. We want to make sure that our upside is high enough, but in case the edge case materializes, that we don't get destroyed completely. Most people have never thought about deterministic thinking versus thinking in terms of probabilities. Most people just go through life by looking at the outcome and judging the decision based on the outcome. But really, that's wrong. I learned this during my poker career. So before crypto, before programming, before all of that, I was a professional poker player for 3 to 4 years. I was living in Gibraltar and in Hong Kong, between those two places, and I'd play online poker professionally for 80 hours every single week. And I paid my study fees with it, I paid my fees in Germany and in Hong Kong, I paid my living expenses, I paid everything during that time, just from poker. But this is where you learn how to refine your decision making, because it's all about probabilities. Let's say you've got a very high chance of winning a certain pot. You might go in this particular hand all in and you've got a high expected value. If you do this for long enough, you will make money. But you're not going to do this with all of your money. You still have bankroll management. So you look at how many buy-ins do you still have left relative to what's currently been played for. Let's say you've got 20 buy-ins or 50 buy-ins. And so if one buy-in goes down, even if you bet all your money with that buy-in on an 80% winning chance, it's okay. You can lose one buy-in and maybe lose 5% of your net worth, of your bankroll, because you can recover from that. You would never use your entire bankroll on a single game, because even if you've got an 80% likelihood of winning, you've got a 20% likelihood of losing everything. And so it's the same with trading, right? Even if you had a massive edge in the market, even if you would make 80% winning trades, if you just bet too much of your capital, you're just waiting to get ruined. You're increasing your risk of ruin by increasing how much you're betting over time. If you're really a long-term winning player, you don't necessarily have to bet that much. There will be enough opportunities to make money in the market. Really, if you feel the urge to take more risk than is healthy, probably you don't really have that much of an edge. Probably you just want to make money quick. So in poker, it's a bit easier to quantify because we just have cards, we've got a deck, and we can kind of estimate the probabilities. So let's say we need one more card in order to fulfill our final hand. Let's say we need a flush, right? We've got a flush draw, so we need the same kind of color, and we just need one more card. Now, in poker, we've got a deck of cards of 52. So there's 52 cards in a deck. Now, if we have our flush draw, we can just calculate how many more cards are there of that particular color currently in the deck. So we can see, okay, what have other people potentially folded and folded openly? Or we can say how many cards of that color have already been played. In our particular case, let's say we've got a pot there of $100 and somebody is betting, say, $10 in that. We have to pay $10 to potentially win $110. Can we do that with a flush draw? The answer is yes, because there's more than just 5 cards of the same color left in a deck after we are at the river. So that's an example. We look at how many cards bring us to our winning hand. We multiply this by 2 because there's 52 cards in a deck. So when you've got 5 cards that bring us to the winning hand, you probably have a 10% likelihood of winning. And then we just compare how much do we have to bet relative to our probabilities. So this is essentially how poker works. The beginner player, he might think it's a bad idea to put in those $10 for a flush draw if in the end the river doesn't complete the flush. Right? The beginner might say, the outcome was bad. I didn't get the winning hand. I shouldn't have paid those $10 in order to win because I didn't win. Or the beginner might say, I'm okay to put in another $100 in order to win those $100. that would also probably be a bad decision. But if the beginner then has won, he might reason, hey, it was a good idea to pay those $100. But really, it was not. You might have won this time, but if you do this often enough, you will not win. So it's a bad idea to think about the outcome. It's a bad idea to just go to the casino and play roulette. Even though you might have won today playing roulette, if you do this often enough, you're not going to win. Thinking in terms of probabilities will improve decision making. Try to decouple the outcome from the decision. So in poker forums, right, where people talk about poker hands, they talk about the situation, but in the end, they actually don't show the outcome. They're only discussing the decision making. They're not discussing what in the end came up on the turn or on the river. They're simply just discussing, was this a good decision in this particular point in time, given the probabilities, given the odds. And so when you're trading, when you're investing, and the outcome in the end was not good, don't think that this was a bad decision. Rather think, did I estimate the odds correctly? Did I potentially miss something? Was this bad outcome a result of maybe not looking at particular scenarios, of maybe forgetting about particular scenarios, of not estimating the odds right? Or was it simply just the bad outcome materializing itself? I did have good odds in my favor, but this time I was simply not that lucky. That's really fundamentally the question that we have to ask ourselves. Really, trading and investing is not about drawing right lines on charts. It's not about the execution. It's much more about skill development. It's about finding out how we can get the odds in our favor. Because that's a nice thing about poker, that's a nice thing about trading, and that's why roulette, for example, is not so great. In poker and in trading, we are playing against other humans. If we can estimate the odds better than the general market, we can make money. We can estimate the odds better on the poker table than the other people on the table. We can make money despite the fees, right? We still have fees. We still have to pay the market makers. We still have to pay the casino for providing the game. But if our edge is higher than the fees, if we can make money from the other players at a quicker rate than the fee that's getting paid, then we are compounding our capital quicker than the rest. So it's all about learning things. It's about learning how to do backtesting. It's about learning how to do statistics. It's about getting an edge. It's about finding a reason why the market long-term should give the capital to you versus all of the other competitors. What do you know that other people don't know? What kind of structures have you discovered in the trading mechanisms that other people have not discovered? What kind of information do you have? Do you know the project leaders, the project creators more than others? Do you know what's coming that most people don't know? Do you know other winners, and are you potentially adopting their ways of playing the market? Fundamentally, you need to have a reason why the market should reward you and not others. And ideally, that reason is growing over time. Ideally, you get more and more edge in the market over time because the market itself is maturing, right? The market is becoming better and better over time as well. And so you need to refine your approaches more and more. You need to learn at a quicker rate than the average market participant. This is really where outperformance is coming from. If you're beating the market this year and you're not learning anything, you might not beat it next year because the market itself is improving. The market itself is learning. Again, there is skill and there is luck. There is the expected value and there is the part of the trade that's completely out of our control. The bigger our skill is, the less important the luck component becomes. The longer we trade, the more important the skill component relative to the luck component becomes. If you go to the casino for long enough, you do many games for many years, and you do this with blackjack or you do this with the roulette table, you're pretty much guaranteed that the expected value, that the probabilities will take over and that you're going to lose and that the casino is going to win. And so the same is true for trading. If you simply just continue to learn and you continue to trade and you learn quicker than the rest, over time, if the sample size is large enough, you are going to be winning. But again, it's the minority that wins, right? It's maybe 10%, maybe 5% at the expense of all the others that underperform. It's the same in poker. There's a few winning players and there's many losing players. So really, it's not just about being above average. We need to be in the top few percent of winning. And that's why it's so important to focus also on just one market and try to beat that market. Don't try to beat the precious metals market. Don't try to beat the stock market if you've already that much time invested in the crypto market. Find one market where it can be better than 95% of people, and then you're also going to generate some alpha. If you got some value out of this video, feel free to give this a like. Feel free to also check out the other mindset and strategy videos. Just click here on the channel, click to content, the playlist. There's a playlist with many videos like this. Feel free to binge watch them. Thanks again for being part here of the YouTube community. Feel free to also check out the premium community. That's where I share my own trades and my own investments. Thanks for watching. See you next time. Cheers.